Hi, I'm Steve Breen with Prosperion Financial Advisors. Welcome to this edition of Prosperion. During a recent client meeting, we ended up on the subject of social media and the effect that it can have on a business. Unfavorable press coverage led to an echo of bad news on social media among this particular client's customers, and it was continuing to harm his business with no end in sight. Well, I was curious about the public's persistent reaction and what he believed was the story still in the news cycle many weeks later. Was his customer base just being fickle? Were competitors spreading false rumors or redundant stories? His response? Social media. Once a key marketing strategy for his company, social media had quickly turned into a sore spot. He explained that as the public hears about small incidents, they turn to social networks to share that information, which then is amplified and repeated, creating a snowball effect. Suddenly, what were isolated incidents created a nationwide panic. The small problems became bigger than expected, and a stampede occurs. As a financial advisor, I started thinking about this and how it applies to investors. Consider both do-it-yourselfers as well as new investors, those who are not deeply grounded, long-term oriented, or experienced. Could social media be driving these investors toward short-term thinking? Could it be the volume or the loudness of the media in general? Could this be pushing investors to make choices that are detrimental to the longevity of their wealth? And if so, what could the long-term consequences of all of this noise be on investors? Consider the past few months of daily volatility. In the first 48 days of 2016, 26 of those days, roughly half, had over a 1% change according to LPL research. Now that's daily volatility. What causes this? Since 1980, the S&P 500, a broad market index, has had on average corrections of declines of around 14.2%. There are times when these corrections have not occurred, most noticeably in years that immediately followed larger bear markets, similar to 2009. But this trend is not unheard of. When we go through a long period of a negative return, markets historically rally for an extended period of time with few corrections. So in 2015, in August, we finally had a slight correction, around 12%. What did investors do? Many of those investors sold their investments, their ETFs, in droves. Then 2016 rolls in and brings in a correction of minus 14.2%, exactly the long-term average over the last 35 years. And the results were 6 straight weeks of net redemptions out of equities. Once again, the public is doing the opposite of what a successful investor behavior is. As the markets rise, my prediction is that we'll see the public slowly buy back in again, buying high and completing the circle of everything investors are not supposed to do. I believe the media is generally harmful to investor behavior. You see, it encourages investors to do the wrong thing, sell when prices are low, which is brought on by the fear emotion, and buy when prices are high, brought on by the greed emotion, all perpetuated by the media, including now social media. The real problem is investor behavior, reacting to the emotions of fear and greed brought on in great deal due to the media, social or otherwise. So, the next time you hear a catchy headline or hear from a friend about some sensationalized story, stop, think. Is this designed to inform you, to educate you, or rather to get your attention and instigate a reaction? The answer might surprise you. If you'd like to have a conversation about our philosophy and strategy to help investors make wise choices with their resources, give us a call. Likewise, if you know of a friend or family member who might benefit from this reminder about investor behavior, please forward this video to them. Thank you for being a client of Prosperion Financial Advisors. I'm Steve Breen.